Hey everyone, 2023 has been a difficult year for passive income investors, especially those looking to invest in dividend stocks. The main reason for that is because of competition. For over a decade, dividend stock investors had little competition in terms of other forms of generating passive income. That's because government bonds were yielding so little. But now, ever since the Federal Reserve has been on a campaign of raising interest rates, dividend stock investors have competition. What I have in the chart here is the yield on a 10-year government bond, which was below 1.5% to start 2022. But as you can see, this yield has risen significantly over the last 2 years. And as of this recording, investors can generate nearly 5% yield income from government bonds, which are the safest investment according to most investors in the stock market today. So if you can get 5% on a government bond, that's super safe. Why would you want to invest in dividend stocks? And so that's been the push and pull here from dividend stock investors and passive income investors looking to generate passive income. They now have a choice outside of dividend stocks. However, the one downside with investing in government bonds instead of dividend stocks is you're not exposed to the upside that dividend stocks can offer. Remember, with the government yield, if you buy a 10-year government bond at 4.9%, that's going to be your yield. That's going to be your yield to maturity if you buy and hold for the duration. But if you invest in a dividend stock and you're getting a 4% dividend yield, by the end of those 10 years, that dividend could double, it could triple, it could quadruple depending on the performance of your company. So you're giving yourself that potential upside as opposed to what you're not getting from the government bond. And over long periods of time, dividend stocks handily outperform government bonds. So with that being said, in this video, I'm going to highlight 7 spectacular dividend stocks you could buy now in November. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Starting with Altria Group, which offers investors a dividend yield of 9.43% and is trading at a forward price to earnings of 7.8. The stock is not expensive. Of course, this is not a growth company. You're not going to experience growth with Altria stock, but you are going to experience a company that generates very solid profit margins, gives you a healthy dividend yield, and is selling at a cheap valuation. The next stock I'm going to recommend in my list of 7 dividend stocks to buy now is Microsoft. The dividend yield on Microsoft might not be exciting at 0.81%, but Microsoft has been investing in artificial intelligence. The company's got a dominant position in the personal computing industry, and it's trading at a fair valuation of a forward PE of 26. It's in an excellent position to benefit from the rising effectiveness of AI, and so its revenue and profits are in a good position to grow over the next decade. And so investors buying Microsoft stock today can reasonably expect this dividend to increase over the next 3, 5, 7, and 10-year time periods. The next stock I'm going to recommend is AT&T, which offers a dividend yield of 7.29% and a forward price to earnings of 6.01. So selling at a cheap valuation with a strong dividend yield. One of the things I love about AT&T stock is its massive cash flow generation. The company generates billions in cash flow every quarter, and it's in a business where more than 99% of the customers renew every month and every year. So it's in a strongly sticky consumer business, and I like that right now, especially as the economy worldwide is in a risk of slowing. I want to be in stocks like AT&T that are the last thing consumers are going to cancel even if they lose their jobs or experience a decrease in their income. Next, I have the Home Depot, which offers a dividend yield of 2.93% and is trading at a fair valuation of 17.21 forward price to earnings. Now, I've been following Home Depot for nearly 5 years now, and the one thing management always says over and over again, the main reason people spend money on their homes is when they see their home values increasing. And home values have been rising significantly since 2019. There was a brief scare in the middle of 2022 when home prices fell very slightly, but they've been back on the rise again, even though interest rates and mortgage rates are near 8%. And with mortgage rates at near 8%, people are hesitant to move, sell their existing house to buy another one, and trade their low interest rate mortgage for a high interest rate mortgage. Instead, if they need something, they're likely spending money to add it to their existing home instead of selling their existing home to go out and buy another home. And I think that bodes well for Home Depot in the near term. And then longer term, the company has been an excellent performer in the home improvement industry, outperforming rivals, generating nearly 10% compound annual revenue growth, and even better earnings per share growth over the last decade. For those reasons, I like Home Depot stock at these valuations. The next stock I'm going to recommend is 3M, which offers a dividend yield of 6.76% and it's trading at a cheap forward price to earnings of 9.09. 3M is plagued with two risks right now that are bringing down the valuation. Number one are legal issues that are costing the company billions of dollars. And number two is that 3M benefits when people are spending money on goods more so than when people are spending money on services. But what's been happening in the last year is that people are unleashing pent-up demand to buy services, things like haircuts, travel, going to ball games, theme parks, movies, things like that. And that's been hurting 3M in the short term. However, longer term, I fully expect consumer spending to reach that balance it was around 2019 on their share of goods and services being more balanced, and that will benefit 3M going forward. And in terms of the legal issues, I'm not an expert in legal issues, but if I was to bet, I would say that 3M can handle these. They've got enough money to serve these legal issues if they are to experience the downside of them, and they've got a big and powerful legal team to fight these cases, and I think they'll be fine going forward, even if they were to reach unfavorable outcomes in these legal issues. Next, eBay, the e-commerce site, offers investors a forward price to earnings of a cheap 8.726 and a dividend yield of 2.52%. eBay only started paying a dividend in 2019, although the company generates strong profit margins and strong earnings per share, which makes it a prime candidate to pay dividends. Also, the company runs on an asset-light business model that doesn't require heavy capital investments, which is another favorable aspect of a dividend paying stock. When eBay generates profits, it doesn't need to use a big portion of those profits to reinvest in the business, and that makes it available to pay dividends in increasing amounts. So I like this stock longer term, even though in the near term eBay faces headwinds from that same reason I mentioned with 3M, because consumers are spending more money on services in 2023 than they normally would under normal circumstances. And finally, Deere is the last dividend stock I'll recommend at a dividend yield of 1.38%, selling at a price to earnings of 11.11. Now, Deere is an interesting situation in that its earnings and profits have been soaring in recent years, but the stock is not trading expensively because investors realize that this is like the best of the best that Deere can achieve right now. It's at the top of the top, and investors are expecting a sort of mean reversion from Deere, expecting its profits to come down because right now it's just they're just so explosively good. But I think there's a little more runway for Deere to perform over the next year or two because of the inflation in commodity prices, and all the fiscal spending for construction. Additionally, Deere has raised prices on its equipment, making them more organically profitable, and infused their products with more technology, which makes their clients more interested in upgrading their existing equipment. For those reasons and the relatively cheap valuation, so Deere's earnings have exploded, but investors have been tempered. As I mentioned, they realize that these earnings are not going to stay this high for sustainably long periods of time, so it hasn't been reflected in its valuation. And so for all those reasons, I think Deere is also an excellent dividend stock to buy now. All right, but before I let you go, if you've gained any value from this video, which you probably have if you've made it this far, please subscribe to the channel. It'll help me create more videos just like this one. Thank you so much for watching.